Welcome to the MarketBeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. All right, so Nancy, one of the things you do as part of being a chief financial analyst at Cabot Money Club is you track market sentiment very closely. It's something I've heard you talk about before. What are you seeing right now? What are your indicators showing you?
Well, it's kind of interesting, Kate, because they kind of flip-flop all the time. You know, they always say when individual investors all dive into the market, it's time to leave for the professional investors. And we saw a lot of that up until the last few months. And now the sentiment, the individual investor sentiment, however, has turned a little bit more bearish. It's definitely more bearish than what the institutional investor sentiment is. Because now I'm starting to see the professionals getting back into the market. And you know, if you watch any of the news shows like CNBC, you'll hear them all talking about, oh, now's the time to buy. Well, I mean, I don't know if there's a bottom is inherent in the next few days or months. No one can really call a bottom. But, you know, it's always smart, in my opinion, to be in the market. I wrote an article about that in the magazine, I think it was last month, and talking about the statistics, looking at if you try to time the market, how bad you generally are. Even the professionals are generally pretty bad about that. And as you know, at Cabot, we don't really time the market, but we do look at trends. And the trend definitely looks like the market is starting to find its bottom. Again, I would never sell all of my stocks. I would never cash in my 401k or my IRA because that's just crazy. I had friends do that back in the recession, and they didn't do it when I knew about it. They told me about it later, and I said, are you crazy? I mean, the market goes up, it goes down, it goes back up again. So sentiment right now looks pretty interesting. It's still low for the bulls. There are more bears than there are bulls out there on both the individual investor and the institutional investor side. But it seems like, you know, as of today, it looks like it's getting a little bit better.
You know, you bring up a couple interesting points. And one thing that occurred to me is the idea of individual investors believing they can time the market correctly. And I remember seeing this back when I was a financial advisor and people would come into the office as prospects, not yet clients. And I would so many times have to tell people back in 2010, 2011, that the market had been in rally mode after that bottom in 2009. They were still terrified and afraid to look at their holdings because they had no idea what's going on. So it's not as easy to time as people think, is it?
No, it isn't. I mean, even for those of us that have done this for a living for, I won't tell you how many decades. Yeah, it's pretty impossible. I remember back in 1987, that might have been before your time in the market, Kate, but Elaine Garzarelli, who worked for Lehman Brothers at the time, made a huge name for herself by calling the October 1987 downturn. And that was basically her last big hurrah. I mean, I think she's still in the business, still managing money, and I'm not saying anything bad about her. It's just that it can happen occasionally. You know, a stopped clock is right twice a day. So I would just never put my faith in anyone who said that they could time the market. Years ago, I was asked to join a company that I ultimately decided not to, and they were teaching seminars for $5,000 a pop. And it was all a little green and red arrow system. So here's when you buy and here's when you sell. I'm like, oh, that makes no sense to me whatsoever. So no, it's not possible.
Yeah, it does seem easier from the outside. And I think people believe, well, I'll just get out now and get back in when the rally starts again. But then people don't believe the rally has started and they miss it. I see that a lot.
Yeah. And, you know, the important thing, as I said before, is to remain in the market. It doesn't mean you have to remain in the same exact stocks. I mean, I always believe in taking money off the table. When you start making a profit, put that money in your pocket. Yeah, you may have to pay capital gains on it, but it's better to have the money in your pocket and then look for another opportunity. I mean, this time that we've been in the last few months with high inflation, rising interest rates, means that we need to look at maybe alternative things that are not in our portfolio right now. Maybe something a little steadier, a little more conservative, a little more value oriented.
Right. There's certainly ways to look at dividend payers, for example. And for investors that maybe are not as conservative, there are vehicles like inverse ETFs. And I'm not talking about those 2X and 3X things, those are very risky. But as a trading vehicle, we have inverse ETFs now that I've been able to use successfully in some of the portfolios that I run. And there are just a lot of ways today, including using options, that people can make money even in a downturn or a sideways trading market. So I agree with you, Nancy. The idea of stampeding into cash is kind of outdated, isn't it?
It really is. And I recall back in the tech wreck, I mean, I was really running around the country all the time, then speaking at all the various money shows and different investment expos. And during 1998 and 99, I mean, you could just throw an arrow and any company that had any sort of technology was going up 40%, 60%, 100% overnight. And I would do my presentations at these expos and I would say, how many people own XYZ stock? You know, the entire room had owned this stock that no one knew anything about, had never made a profit in its lifetime, couldn't explain it to the grandmother if they tried. And then, of course, the bottom fell out and everybody lost most of that money. During that time, I just couldn't figure out what a lot of those tech stocks did. And I would, at that time in my newsletter, I was traveling around the country and visiting all of the companies that I wrote up in my newsletter. And I would always say to them, forget the jargon. In 25 words or less, tell me in plain English what it is that you do, you make, who do you sell it to, blah, blah, blah. And if I could get that, then I could understand the stock. If I couldn't understand it and I wouldn't recommend it. And I put some of those stocks in my portfolios and they ultimately got bought by bigger companies and we did very well. But at the same time, I was loading up on dividend stocks and real estate investment trust.
Okay. Yeah, you make a really good point. Is a lot of times the case sounds great. You'll have a stock that is showing a lot of technical momentum. And it is certainly true that if you understand how to use technicals, have some ways of exiting when you have a profit, then those can be okay. But if you think this is just the kind of thing you're going to let run forever, that may come back to bite you at times, can it?
Yes, exactly. It can. And, you know, the old days when I first got in the business, it was you have the fundamental analyst, which is what I am and always will be, with a little technical thrown in. And you have the technical analyst, and the two never met. And the technical analysts are all back then, you know, trade on these, look at the bar charts, look at all of the head and shoulders charts and all that stuff that I never really took the time to learn, that I know you do understand that. And the fundamental analysts were just, look at the company, stupid. You can buy this company and hold it forever. Well, that's no longer true. I mean, years ago, people used to hold, like, remember Pan Am, the airline? That was a great stock for years. And people bought it, then their kids inherited it, then their grandkids inherited it. But there's hardly a stock alive that you can do that with anymore. You know, you really have to look at the fundamentals of the company and you have to look at the technicals, because you have to know when's a good time to buy and when's a good time to get out. You just cannot any longer put those stocks in your portfolio and forget about them.
Right. Particularly, to come back to what you said a minute ago, if it is something that the business case may be a little difficult to understand, or you have to dig into the numbers that most people just won't do. I mean, recently there was a company, and I don't want to misspeak, but it was one of the consumer lending online platforms, that it turned out that they may have had some bad loans on their books, and that tanked the stock. And that's the kind of thing that I'm afraid people tend to just look at the momentum and don't realize what the risks might be inherent in one of these. And these are things that you look at when you're doing your stock analysis to this day, isn't it?
It is, yeah. And individual investors, just, you know, as I said before, they have the habit of getting in the market at exactly the wrong time. I remember I was taking a limo from the airport to one of the hotels in Las Vegas for a money show. This was back in 2008, and the limo driver was talking to me about flipping houses. And I thought, oh boy, it's time to get out of the housing market. You know, it's just like you're in a cab in New York and the cab driver's talking about buying stocks. You're like, yep, time to get out. But yeah, you've got to look at the fundamental factors, because honestly, no matter how good the technicals are, if the company is lousy, you shouldn't buy it unless you're day trading or something, which I don't recommend. But, you know, you have to I look at a lot of factors, but, you know, you can boil them down. In fact, the Bible of securities analysis that was written by Graham and Dodd back in the 1930s is still very, very relevant today. And I remember him saying, and Warren Buffett, who was a student of Graham, and Ashley Graham was his teacher at Columbia, he always said there's really 5 things you need to know about a company, and you can analyze almost any company with those 5 things. However, each industry also has additional things you may need to look at. But I mean, basically, if you look at cash flow of a company, are they making money from what they're doing? I mean, if they make bicycles, they shouldn't really be making that much money off their real estate investments. Most of their money should come out of making bicycles, and that's basically your operating income line on your cash flow statement. You look at debt, and I explain to people that it's the same thing as your personal debt. Years ago, I was in banking, and a young man came in, and he owed $88,000 on credit cards. He was probably in his 20s, and he made $44,000 a year. And he was looking for some kind of a consolidation loan. I couldn't help him. He had no equity, but it's just the same with a company's balance sheet. You look at their debt and then look in their notes to financial statements to see, what their interest rate is. Is it variable? How much are their payments for leases and loans? Are they making enough money to cover them? It's that simple. And then they should have additional money so they can build their company. But, those are 2 of the most important things. And of course, the valuation of the company, whether you're looking at the PE ratio or the price to growth ratio, you want a company that is valued at a reasonable level. And in the old days, anything with a PE under 10 was considered cheap. Over 20 was considered expensive. And then the middle was where you bought. Well, that's out the window now because even though I love value-based companies, I have certainly bought a lot of companies with PEs of 65 or higher.
It's changed. You're right.
Yes, if they are trading, and if they have the bones, basically. I also like to look at ownership of the stock. How much is institutionally owned? How much is individually owned? And that varies so much by industry. I mean, if you look at utilities, you have 1% insider ownership, which is tiny, but it's not really tiny because they have millions and billions of shares outstanding. But if you're looking at a regional bank, you're going to be more interested in how much do the executives of the bank hold and how much do the founding family hold. And if you're looking at a stock that has 98% institutional ownership, you're going to know that you're going to have a lot of volatility in it, because it's the herd mentality. As you know, if one analyst on Wall Street says, let's sell the shares of XYZ, everybody else does the same thing. So that's going to cause your stock to go down. So, somewhere between 30 and 65% is probably a good ratio to look at for institutional ownership. And I guess one of the last things I look at is how many analysts are following the company and who they are. And it's sort of the same with institutional ownership. It can make it very volatile. I always love to see 1 or 2 of the little regional boutique analysts that really know the company because they're located in that area. I like to see them following. I don't really care so much whether analysts say buy or sell because they almost always say buy. But what they're really good for is industry analysis. So if you're not interested in a company in a particular industry, call your brokerage company and say, hey, you got any analysts following this company? And then you'll get a lot of information.
And one thing I should add, because this is the MarketBeat podcast, MarketBeat does provide a wealth of information about analyst coverage, who it is, what their ratings are. So there are absolutely many places, including MarketBeat, that you can get this information very easily. Not sure what stocks to buy and which to sell? Well, no worries. MarketBeat has you covered. Get the latest buy and sell ratings from Wall Street's top performing, most accurate, and most respected research analysts. That's just one part of what you will receive as a MarketBeat All Access subscriber. You'll also get MarketBeat's new trending stock lists, which monitor social media chatter in real time to help you identify the next GameStop or AMC before you hear about it on the news. MarketBeat All Access also features real-time news, market events, and performance data for your stocks with the MarketBeat portfolio monitoring tool. And you can take a completely risk-free trial for just $1 if you head over to the link we will put in the show notes. You'll get best-in-class stock research tools, performance ratings for Wall Street analysts, real-time news feed, executive support team access, all of this ad-free for just $1 for the first month. Sign up today. The link is in the show notes. And one thing about the analyst coverage too is in smaller companies, the analyst coverage is pretty sparse, isn't it? So what do investors do in that case, Nancy?
Yeah, well, that's the kind of companies I used to travel to see. So small and mid-cap companies, and I would go visit 3 or 4 every month. And yeah, because it's hard to get that information. But if you look at the local newspapers where they're at, they'll follow those companies. They usually always have some sort of a business newspaper, and you can get a lot of information. And the other thing is utilize that investor relations person.
Yeah.
Because they, a lot of times, know more than almost anybody else at the company. I mean, they really dig into the numbers. They work very closely with the CFOs. And, even if you own 5 shares, still, they'll talk to you.
They will.
Yeah, I would always say give them a call, because those people, they do work really, really hard. And they're not the hypesters. The hypesters you want to stay away from. But these are people that have legitimate reason to promote their company's stock.
Years ago, one of my colleagues at Investors Business Daily was doing some research into a very small company, very tiny market cap, not a penny stock, but just a company with a small market cap. And he called the number that he found, and assuming he'd get maybe an investor relations person or an assistant, the CEO picked up himself and answered his questions.
Well, I mean, that's the beauty of some of the smaller companies, because when I visited these companies, I almost always met with the CEO and the CFO, or at least one of them. And it was fascinating because, especially the CEO, oftentimes he was the founder of the company. The guy's like has ants in his pants. He can't settle down because he's so excited about his company and his product, and it's contagious. And you think, wow, this guy probably he's really invested in his company. And those are the kind of people that you want to see. And then other times I went to visit a company that made vitamins. It was a wellness company. So now I'm thinking, okay, they're going to give me the whole spiel, like, what do you eat and what vitamins do you take? The secretary to the CFO comes out with a cigarette hanging out of her mouth.
Oh, no.
I go in to see the CFO. He's got ashtrays piled high and thinking, oh, my God, now you knew I was coming. You should have hid those.
Yeah, that would give me pause about investing in that company. Just saying. Yeah.
Yeah. It's crazy stuff. One time I went to a company that made shoes, and they wouldn't let me look at their warehouse. And I'm like, oh, that's weird. That's really weird.
Yeah, not good.
No. Another time I went to visit Hormel. Back then they were mostly a pork producer. And those guys, I talk about excited about their business. Of course, by then they'd already been in the business 100 years, and they had made scads of money. But they wanted to know if I wanted to see the slaughterhouse. I'm like, no, thanks.
No.
No, I don't want to see how they make spam.
Yeah. You've got some stories there, Nancy. Some of these should go in a book, I think.
Yeah, well, I've always thought about that, about writing a book about the people I've encountered, because I'm telling you, I've always had a deep-seated interest in how people became successful and how they made their companies successful. I was the kid that read all of the biographies in the library in school. But I'll just tell you one more story, which I think is just fascinating. I went to see a company called Cintas. They make uniforms. They're red, white, and blue vans, and they're out of Cincinnati. And talking with the people there, how'd you get started, blah, blah. So how they got started was the founder of the company was a circus performer during the Depression. He was an acrobat. Well, nobody could go to the circus during the Depression. There was no money. He had a wife and small child. So in Cincinnati, there were a lot of machine shops downtown, and they would throw their greasy rags out at the end of the evening in the alley. He went and collected them and started laundering them. And that's how that company got started.
Very clever, and shows the resourcefulness of these company founders. Yeah, very much so.
Really interesting. So, back to Cabot Stock of the Month. I mean, we've got a few things in our portfolio. We're pretty new at this. And this is really sort of an introduction to the Cabot Analyst and all of the newsletters that Cabot provides. And I actually excerpt from 13 different newsletters. So whether your interest is in growth, ETFs like you do, Kate, value, income, options, crypto, you name it. I mean, we're going to talk about it in the newsletter. And, having analyzed companies for 30, I don't know how many years, 35 years or more, I think I have a good catbird seat to kind of decide, what's kind of good for the current economy.
And not much good to say about crypto right now, but we'll just breeze right past that. Yeah.
Yeah, we will breeze right past that.
And we don't cover that on this show very much at all anyway. So.
Yeah. Well, and I don't know anything about it. I mean, other than what I see on the news. But I will say this, I wish I had bought it 4 years ago.
Sure.
So let me just tell you about we've only got 3 in the portfolio right now. I'm in the process of writing the next issue, which will be an income stock as a little teaser. But right now we have one growth stock that I actually put in there in April. It's called GitLab, GTLB. And that came out of Tyler London's Cabot Early Opportunities. But it's a kind of a hard company to understand. It is leader in the DevOps. So what it is, everybody's always making all of these applications for and writing programs for pretty much every application you can think of. And this kind of collaborates them together so that people, remember how there used to be open sourced and closed source with software, and Microsoft wouldn't write software that Apple could use? Well, that's kind of gone by the wayside. So this is kind of doing the same sort of thing in the development of applications and operations. It allows developers of different software to collaborate together. So it's pretty cool. And, we're up about 5% on it, which I guess is pretty good since April. The market's mostly gone down. But a GTLB is the symbol of that. The one I wrote about last month is MI Homes with the symbol of MHO. And you probably think I'm totally insane to recommend a home builder. It's the 13th largest builder in the U.S., and they're in 16 different markets. They've managed to expand their markets over the last few years. They're actually making money, and their markets are very diversified. So I think that even though home prices are starting to retract some, sales are going to go down this year. I know that that's going to happen just because of the way that the market is, and especially if we do hit a recession. But I think they'll be able to weather it. They've weathered it since, I think, 1996. So they're really in pretty good shape.
And I think these companies know that the home building market is cyclical anyway. So they hopefully a good company would keep that into account in their business planning, right?
Right. Yeah. And many of them have spread out into financing the homes, handling title insurance, that kind of thing, so that you are somewhat diversified. Because believe me, I own a real estate company, and I've been in the real estate business for almost 20 years. I've seen every cycle so far. I mean, a lot of the people new in the business now have never seen this kind of cycle because it's been so great for the last really 6 to 9 months. But it's changing now. But you still manage to survive. You do things different in your business. You have sales and those kind of things, and they will definitely slow down in development. That has to happen. Interest rates, of course, as they're going up and inflation goes up, people still think that, that's going to kill the housing market. Let me just say this. The first home I bought was at a 14% interest rate. People still buy homes when interest rates are higher. You just maybe can't buy as much of a home as you wanted to. Maybe it's not in the prime location, but you can still buy a home. And what happens in times like this is you get all these little programs popping up that the government advocates. If you're a veteran, you can do a VA loan. You can do an FHA loan if you're lower income, although the income now is pretty darn high. And you can buy houses with FHA that are much higher than what you could in the past. And I know in our local area in Tennessee, you've got THDA and USDA, and they also will help people with down payments and that kind of thing. So that market's not going to dry up. So I'm still a big fan of that company. And the last one in our portfolio right now is DJD, which was a ETF that you recommended, Kate.
I hold this one. Mm-hmm.
Yeah, and it's the Invesco Dow Jones Industrial Average Dividend ETF. It currently has a 3.1% yield. Most of its sectors, the biggest part of its sectors are in healthcare, technology, and finance. And some of the companies that hold are IBM, Dow, Verizon, Chevron, Cisco. So it's a real solid company, a real solid ETF. And I think that in this particular time that we're in, those are really the great things that we want to look at. We want to look at stocks and ETFs and even mutual funds if you're a fund buyer that has some solid fundamentals into them that, you can go to sleep tonight knowing that you hold this rather than having to worry about, should I get up at 5 to make sure I can trade this thing? Because that's not the kind of stock that I like to invest in.
And that's not any way to live your life either. I don't recommend that type of trading with that sort of obsessive focus either, because it all comes crashing down around you. It's not sustainable, really.
No.
So, Nancy, how do the listeners learn more about what you're doing at Cabot Money Club?
Well, the Cabot Stock of the Month is on our Cabot Wealth website. In addition to that, we have the financial magazine, the Cabot Stock of the Month magazine, and I do a lot of different things on there. They're mostly related to investing too, but I've talked a lot about inflation the last couple of months, and I gave tips in June about how consumers could actually help combat inflation. So there's probably 2.5 years worth of magazines on our website, and they offer anything from estate planning to handling your 401k, your IRA. So pretty much anything financial you can think of.
All right. And we will put that link in the show notes. All right, Nancy, thank you so much. Pleasure to have you on the show today.
Thank you, Kate. Appreciate it.
Thanks again for listening to the MarketBeat podcast. Do not forget to subscribe on Apple Podcasts, Spotify, Stitcher, Google, anywhere else you get your podcasts. And you will also find us on MarketBeat.com. If you enjoy the content here, please give us a 5-star review so others can also find all the great interviews and market insights that we bring to you each week. Also, did you know that MarketBeat has a YouTube channel? We sure do. The podcasts are there, as well as tips for getting the most out of MarketBeat and becoming, as always, a better investor or trader.